So what's in for this week in Forex? Let's start. Bearish on gold and mixed on silver. Reasons. Gold's outlook. The weekly forecast for gold is bearish, influenced by its close tracking of the USD and Treasury yields. A notable factor is a hotter-than-expected Producer Price Index (PPI) print, coupled with persistent U.S. CPI data, which contributed to strengthening the U.S. dollar and U.S. yields. This scenario has exerted downward pressure on metal prices. Despite the U.S. economy's robust performance, expectations for the Federal Reserve's rate cut seem to be pushed further, potentially realigning market expectations and affecting gold prices negatively. Moreover, gold's reluctance to break below the $2,010 support level signals a potential for further downside, with key levels at $1,984 and $1,973 serving as subsequent challenges. The analysis suggests that gold may attempt another break below $2,010, influenced by upcoming economic events and broader market sentiment. Silver's outlook. Silver presents a mixed view, showing short-term resistance but indications of longer-term consolidation. The weekly analysis highlights silver's resilience at the 38.2% Fibonacci retracement level of $22.45. Suggesting a potential for mean reversion towards higher levels such as $23.90 and $25. However, the daily chart reveals resistance at the convergence of the 50 and 200-day simple moving averages, which have so far capped the upside potential for silver in 2024. This dynamic resistance points to a cautious outlook for silver, with the possibility of retesting lower levels if it fails to surpass these averages. In summary, the analysis underscores a bearish stance on gold due to its sensitivity to U.S. economic indicators and Treasury yields, while silver exhibits a more nuanced picture with immediate resistance levels posing challenges for upward movement, yet showing potential for consolidation over the longer term. Mixed outlook for euro pairs. Euro to U.S. dollar, neutral to slightly bearish. Analysis. The euro to U.S. dollar pair exhibits a neutral to slightly bearish outlook, characterized by a pattern of lower highs and lower lows, and trading below key simple moving averages, SMAs. The immediate resistance is noted at around 1.0787, followed by resistance from the SMAs and the 23.6% Fibonacci retracement at 1.0865. Key support levels are identified at 1.0700 and 1.0635. Sentiment. Retail trader data indicates a balanced but slightly net long positioning, suggesting potential for further downside in line with the contrarian view to crowd sentiment. Euro to pound sterling. Bullish reversal potential. Analysis. Euro to pound sterling demonstrated a notable turnaround, rebounding strongly from multi-month lows to breach the 20-day SMA. A sustained move above 0.8573 would break the recent pattern of lower highs, potentially setting the stage for a push above 0.8600, with resistance around 0.8620 next in sight. Outlook. The pair shows signs of bullish reversal potential, particularly if it maintains momentum above critical SMA levels and recent lower highs. Euro to Japanese yen. Bullish, driven by yen weakness. Analysis. The pair has advanced above all three SMAs, aiming for multi-week highs, primarily driven by weakness in the yen rather than euro strength. The target for the pair is the November 16th high at 164.31, contingent on the absence of Bank of Japan or Ministry of Finance intervention to address the yen's depreciation. Considerations. Traders should remain cautious, as any indication of intervention, likely starting with verbal warnings, could rapidly reverse the yen's recent decline from its extended positions. Economic and policy influences. The European Central Bank, ECB, is anticipated to be the first major central bank to initiate interest rate cuts, influenced by forthcoming economic data releases including PMI's IFO Business Climate Index, and final GDP and inflation figures for the euro area. This backdrop, especially if data underscores weakness in the eurozone, may pressure the euro in the coming weeks. Summary. The upcoming week presents a mixed outlook for euro pairs, with euro to US dollar facing slight bearish pressures amid lower highs and lows beneath key SMAs, euro to pound sterling showing signs of a bullish reversal after a significant bounce from lows, and euro to Japanese yen exhibiting bullishness mainly due to yen weakness. Economic releases and central bank activities, particularly from the ECB, are crucial factors to watch, as they could significantly impact these currency pairs' movements. Speculative forces at play amid Middle East tensions. Overview. WTI crude oil showcased resilience last week, holding near its recent highs and demonstrating durable support levels. Despite trading slightly below the week's peak values, the commodity's ability to reverse upwards near the $75.500 mark signals active buying interest. Contrary to the common narrative, the influence of simmering Middle East tensions on the recent price movements may be overstated, with speculative trading and value buying emerging as significant drivers. Analysis. Support and resistance. WTI crude oil has established strong support around the $75.500 level, rebounding from this point twice in the past week. Resistance is observed near the $79.000 level, a threshold that has consistently held in recent months. The speculative range for the coming week is set between $74.000 to $81.300, reflecting the ongoing speculation and market sentiment dynamics. Market drivers. While Middle East tensions remain a backdrop concern, the recent uptick in WTI prices is more likely attributed to speculative forces and strategic buying in anticipation of potential demand increases in the spring and summer. The presence of ample crude oil inventories in the U.S. further supports the notion that the current price levels are not driven by supply shortages, but rather by market speculation and investor behavior. Trading outlook. The upcoming week presents a nuanced trading landscape for WTI crude oil. The commodity's performance near the end of last week suggests a cautious stance among traders about taking short positions ahead of a long holiday weekend. This sentiment could lead to sustained or increased buying momentum, especially if unforeseen news emerges during the quiet trading period. However, should the commodity face selling pressure post-holiday, it may test lower support levels, with significant attention on whether it can maintain above the $75.250 threshold. Considerations. Traders are advised to critically assess the impact of Middle East tensions beyond surface-level interpretations, recognizing the role of speculative dynamics in shaping recent price actions. The coming week's trading activity will likely offer insights into the market's directional bias, with potential retest of both resistance and support levels providing opportunities for strategic positioning. Summary. The WTI crude oil market enters a pivotal week, balancing between speculative optimism and cautionary resistance levels. Traders should remain vigilant, monitoring for shifts in market sentiment and external news that could influence price movements. The ability to navigate this complex environment will hinge on a nuanced understanding of the underlying factors driving current trends, beyond the immediate geopolitical narratives. Natural gas weekly outlook. Steep decline amid demand and policy concerns. Overview. Natural gas prices have undergone a significant downturn, marking 8 consecutive days of losses, with a notable 20% decrease since the beginning of February. This decline is attributed to various factors, including a strong U.S. dollar index buoyed by persistent inflation concerns, and a pivotal report from Shell predicting a substantial decrease in liquefied natural gas (LNG) demand by 2040 due to global shifts away from fossil fuels. Key influences. U.S. dollar strength. The U.S. dollar's consolidation gains, following a report indicating enduring inflationary pressures, have impacted commodity prices broadly, including natural gas. This has led to adjustments in market expectations for the Federal Reserve's monetary policy, delaying anticipated rate cuts. Demand outlook. Shell's outlook suggests a long-term decline in LNG demand, aligning with global trends toward reducing reliance on fossil fuels. This perspective reinforces the bearish sentiment in the oil and gas sectors, influenced by policy measures aimed at curtailing fossil fuel usage. European market dynamics. Europe's focus on restocking gas storage ahead of the next winter, requiring an additional 5% LNG supply to match 2023 levels, introduces some complexity to the market dynamics. However, unseasonably warm weather forecasts across regions like London further dampen immediate demand prospects. Technical analysis. The technical outlook for natural gas underscores the bearish trend, with the commodity struggling to find support amid ongoing supply abundance and lukewarm demand. Key technical levels to watch include resistance at $1.99 and $2.13, with potential targets on the downside at $1.64 and $1.53, the latter being the 2020 low. Market movers. Policy and environmental considerations. The global shift towards renewable energy sources and policy interventions to phase out fossil fuels significantly impacts natural gas demand projections. Supply adjustments. Any changes in supply, potentially influenced by policy decisions like U.S. President Biden's moratorium or increased Canadian exports, could affect price levels and market balance. Weather patterns. Seasonal weather conditions, particularly warmer trends, play a critical role in shaping demand for heating and cooling, thus influencing natural gas prices. Outlook summary. The outlook for natural gas remains bearish in the short to medium term, influenced by strong policy trends towards decarbonization, a challenging demand environment, and the prevailing technical and market conditions. Investors and traders should closely monitor policy developments, supply dynamics, and weather patterns for potential shifts in market sentiment. The technical landscape suggests that any rebound in prices may encounter significant resistance, with current levels making natural gas an attractive option for power production, potentially cushioning further declines.